Hey, everybody, we're back again with Mark Collinsworth of Vere Global Financial Wealth Management to talk about how serious the bank collapse crisis may get. Is it being contained or is there much worse to come? But first, we have to straighten out something else about Mark's hat. Now, several viewers out there said they hate your hat, Mark. You look like a homeless person. It doesn't give you any credibility. What's the story with that crazy hat?
The reason why I wear the hat is because if I take it off, I'm kind of bald, and the reflection of the light onto the viewers will blind them, and I don't want to be blind. So,
All right, so it's for a good purpose that you wear the hat. So all you viewers out there critical of Mark's hat, that is the reason, the legitimate reason why. Okay, so let's get down to business. There's serious business now that the joking is over. Mark, the last time we talked a few days ago, they were beginning to contain supposedly the bank collapse crisis to prevent it from snowballing, from the ripple effects. It seemed, the chances seemed at least 50-50 that it was going to be contained. What's the picture now?
well, thank you, Larry. It's really not contained. This is all about optics. They're trying to prevent bank runs. Compared to like 2008, the assets on the bank's balance sheets were just crap. I mean, you could look at the assets and say these assets, the subprime, should be trading at zero. Today, the assets are high quality stuff. They're mostly all treasury bonds, the highest quality that you can have. The problem is when people panic and they pull their money out, it doesn't matter how high quality the portfolio is. They pull the money out, the bank doesn't have any cash flow to run day-to-day operations and it goes bankrupt. And that's what the Fed's trying to do now is they're trying to prevent bank runs. And that's a big problem because that has to do with human emotion, not with mathematical formulas.
Yeah, I mean, a lot of it is panic, which is what caused the great run on banks in '29 and the Great Depression that is ensued. I mean, there were some actual reasons for it, but once the panic starts in, whether there's legitimate mechanisms behind it or not, game over. Everybody panics. So, do you see that kind of scenario possibly developing this time around?
Yes, if the Fed cannot contain panic of having people making massive bank runs, in 2008, you had some bank runs, but the majority of it was subprime assets. A bank run is a whole lot worse than subprime. And of course, this deals with the regional banks. The large banks like your JP Morgans or Bank of Americas don't quite have the same problem. But if you have a massive bank run on these small regional banks, and when I say small regional banks, I'm talking about banks that have like, 50, 60, 70 branches that are only like three or four different states versus your big companies like JP Morgan that have, 10, 12 different operations around the world, brokerage, investment banking, all that kind of stuff. If you have a mass bank run on these small regional banks, it could turn into a problem that makes 2008 look like a day at the park.
Really?
Yeah.
So it's getting to be a possibly very scary scenario.
Correct. It could, if the Fed cannot contain the panic, and this is all about the panic. If they cannot contain the panic, this could turn out to be much, much worse than 2008.
Before we go further with that, regional banks, those are the independent banks that ordinary people go to, next door within their community and all that. But some of them are large and some of them are small. So you're saying that even the large regional banks, the regional banks are, like the common banks that you see, not the big conglomerates. So the larger regional banks will be all right, but there's the smaller ones that may be have to worry about.
It's more of the mom and pop type banks. They just don't have the diversification or the assets to really stop a bank run. Where like something like JP Morgan, JP Morgan has, and this is for all your big banks, Wells Fargo, Bank of America, Citigroup, they have operations outside the United States. They have investment banking, they have brokerage, they have insurance companies, they have private equity companies, investment banking, real estate companies. They have so many different things they can survive a bank run. Whereas a small mom and pop bank where it just brings, has maybe 10, 12 branches, all it does deposits and it does mortgages and car loans. Those banks cannot survive a bank run.
Well, is the Fed going to pull out the smaller regional banks if there's a run on them? Will the depositors be saved?
I think so. The Fed's going to try its best because there's, of course, there's more regional banks. Your mom and pop banks. There's more of those banks than there are the big J.P. Morgan and stuff. So this is really affecting those small banks, and that's kind of the reverse of what you see in '08. The small regional banks in '08, they didn't get involved in the subprime stuff like your big, like your Wachovias and your Bear Stearns. Now the opposites happen. The thing that made the small regional banks so safe in '08, that very exact same thing is what's killing them.
So, in other words, the small regional banks have much more exposure than they did in 2008.
They have much more exposure to U.S. Treasury bonds, and with the Fed raising interest rates as fast as they are, it's killing the asset values of those Treasury bonds.
Janet Yellen, our Treasury Secretary, says everything's fine. They have confidence in the U.S. banking system. Do you believe it?
Well, this is kind of the old thing. If you ever watched the movie 2012, when government officials tell you this is not the time to panic, it's exactly the time to panic.
So, Mark, what's going to happen? I mean, there's a lot of our listeners out there saying, "Oh my God, what am I going to do? What should I do? What should they do?"
This comes down to simply, can the Fed contain a panic? And they're trying their best right now. I'll give you a great example on how they're trying to contain the panic. There's what's called the Federal Reserve has a discount window. It's an emergency window used for banks that are under stress to go to the Federal Reserve and get emergency funding from. Right now, in the past, whoever taps into the discount window, they made it public. So you knew which banks needed that money. And of course, when you found out what banks needed that money, you needed to just avoid that bank because obviously they had some problems. Right now, the discount window, they've put a 2-year block on it. So the Federal Reserve will not disclose the names of the participants tapping into that window because those banks are in serious trouble. They're tapping into it right now. Not only are they tapping into it, but the amount of money that they're tapping into right now has actually exceeded the amount of money they tapped into in 2008 for that emergency lending through the discount window.
And these are the regional banks you're talking about.
These are the regional banks, not the large banks, but the regional banks.
So, if they can't contain the panic, is there enough money to prop them up and to keep deposits safe?
Well, let's look this way. There's almost $20 trillion in bank deposits. What happens if half of those go under?
What happens?
Well, let me give you an idea. If there's $20 trillion in bank deposits, let's put it this way. In 2008, $7 trillion got wiped out. What do you think would happen if $20 trillion got wiped out?
So Janet Yellen is trying to contain panic and she's not disclosing the real story of what's going on right now.
And why would she? She's trying to contain a panic. She's not going to get up here and yell fire in a crowded theater. She's trying to calm people down. That is the main goal of the Fed right now, is to keep people from panicking. If people don't panic, they're golden. If people panic, they are screwed worse than they've ever been screwed in history.
All right, let's say there is a widespread panic. Before that happens, what's your advice to the people out there listening who have their life savings in banks?
If you have one of these, if you have money in one of these small regional banks that, like I said, that has, maybe the mom and pop banks that have 30 or 40, branches, maybe 60, 70 branches, get your money out. Go to a JP Morgan, go to a Wells Fargo. For no other reason, those banks are classified as systematically impossible to fail. And what I mean by that is if a JP Morgan or Wells Fargo or one of your big four or one of your big five banks goes under, the U.S. government will throw the kitchen sink and then some at it to make sure it doesn't go under.
But that very advice, though, could actually induce a run on the regional banks. If everybody starts taking their money out, it snowballs from there.
Well, I look at it this way. My job is to make you money. In 2008, people said, "Why are you shorting banks? Aren't you hurting the banks by shorting them?" No, my goal is to make you money. And that's what my goal is. Help you make money and to prevent you from losing money. If my advice causes a run on banks, so be it. Either I'm going to tell you to run on the banks or someone else is going to tell you to run on the banks. I'd rather tell you to run on the banks so you get out. There's 3 ways to make money in this industry, Larry. You can steal it. We're not going to steal it. You can be smarter. I think we're pretty smart. And the third way is to be first. Let me tell you, it's just a hell of a lot easier just to be first.
Wow. I don't know where to go from here with this advice and this conversation. I mean, this is serious stuff now. And you say that there may be things going on. There's we don't want to put in the category of conspiracy theories, but you say there's some underlying um, suggestions of what's going on under the surface.
Well, yeah, I'll give you an example of Silicon Valley Bank. So, Silicon Valley had a lot of money. I think they had something like $175 billion that was over the FDIC limit. So $175 billion was going to be totally erased because it wasn't covered by FDIC. And the US government came in and said, hey, we're going to cover the entire amount, the 100% of the loans in excess of FDIC. The theory going around now is the government did that because the Chinese government had so much money parked at Silicon Valley Bank, they are trying to protect the Chinese government's bank accounts at Silicon Valley Bank by ensuring 100% of the account.
Now, why would they want to give that special treatment to China?
Well, shoot, it's China. China basically controls everything. They have all the political power. They basically hook, senators up with their girlfriends. They have offshore bank accounts for politicians. Why not protect them?
Wow. Boy, that adds to this whole drama. Um, Mark, again, how did we get here to begin with? I mean, after 2008, it was all supposed to be fixed, stabilized, couldn't happen again. It could be happening again. How come?
You can't fix human greed. And the problem with human greed is every time the government steps in to try to fix a problem that human greed created, all that tells you it's called moral hazard. You just basically put a safety net to say, hey, we can roll the dice as many times as we want and make tons of money by rolling the dice. And hey, if we roll snake eyes on it, the US government's going to come and bail us out. So why not be aggressive? And if the US government would just simply let these companies collapse and not come in and bail them out, yeah, it would be painful, but you stop the pain instead. You'd have the pain, you'd have one painful event versus having 10 or 15 painful events stretched out over a 10 to 20 year period.
But what were they doing that they should not have been doing that led to this situation after
Well,
2008?
a lot of this is the funny thing. So when 2008, banks put a lot of the subprime crap on their balance sheets. For 2008, banks said the government told the banks you need to be a lot more conservative on what you own on your balance sheet. You need to have a lot more treasury bonds and the high grade quality stuff. And banks did that. But when the Federal Reserve raises interest rates 400 basis points, those high grade securities go down in value.
Yeah, and that's the general analysis of those who are apparently telling it straight. Now, also, wasn't this also caused by the removal of Glass-Steagall back in 1999 with the Clinton administration?
Oh, don't get me started on this, Larry. So the Glass-Steagall Act I thought was a fantastic document. It was very small, very concise. It basically said you cannot do these things. It basically shut it down. It was a very well thought out document.
It
And then
prevented
they got
it prevented high risk investments by commercial banks. They
yeah,
separated banks from investment banks, right?
exactly. It shut them down. It basically was very clear in black and white. It said you just absolutely cannot do this. There's no ifs, ands, or buts. And then in 1999, they repealed it, and that basically allowed banks to do the exact same thing that they did in the 1920s that led to the banking crisis of the 1930s. And then, of course, after everything blows up, they put together, I think it was 2010, 2011, they came with the Frank Dodd Act, which
Right.
was this huge, huge document that basically gives me a headache when I try to read it because it's so long and so boring. But it says you cannot do this, but if you do this and this, you can do this. And so it's got all these loopholes in it that basically allow banks to do it. And while we're on the subject, Barney Frank, who was actually the creator of the Dodd Frank Act, Barney Frank, Dodd Frank, ironically, guess what? He was actually serving as a board member on Signature Bank that actually went bankrupt this week.
Isn't that interesting? It goes on and on. So, Mark, again, before we close this session, for people with money in small regional banks, your advice is to get that money out?
Yeah, to go someplace else just to be on the safe side. Because, yeah, the government might cover 100% of your bank account, but there becomes a critical mass to where you just have to sit back and say, hey, we can cover, 500 billion, we can cover maybe a trillion, but you can't cover $20 trillion in deposits, but it's only a $32 trillion economy. Come on.
Wow. Well, Mark Collinsworth of Vere Global Financial Wealth Management should be continued soon as we see how this all unfolds. And I hope it doesn't unfold the way you're envisioning as an increasing possibility. What would you say the chances are of unfolding that disastrously, the way you're saying? Is it increasing precipitously, or is it still kind of up in the air?
If you'd asked me last week, 2 weeks ago, I'd have said, there might be maybe a 3 or 4% chance that you could have another 2008 scenario based on what's happening now with these big banks, the runs on the banks, the tapping into the emergency lending programs and stuff like that. Like, give you an example, the $30 billion backstop the FDIC gave to the Federal Loan Banking Association, which is their emergency backstop. They gave them $30 billion on Monday. On Tuesday, the Federal Loan Banking Association started issuing debt to raise additional money. That tells me the $30 billion they gave them has already been taken. It's already been used up. And now you have over $300 billion that's being tapped into the discount window. So banks are making a beeline right now to bring in capital. So problems are getting bigger and bigger, or the kinetic energy to explode is getting bigger and bigger. And the Federal Reserve job right now is to try to contain the bank runs. That's their main goal right now. It's all going to come down to depositors' emotions on controlling this.
Well, all right, Mark, to be continued. Mark Collinsworth of Vere Global Wealth Management. Thanks for being with us.
Thank you very much, Larry. And as I always say, it's always the darkest before it gets really, really bad. And right now, it's pretty damn dark.
Hats off to you, Mark.
That's all.
See you later.
See you later.